This is no longer just about taxes on imports. It's about how a ripple effect can turn into a wave that hits everything from consumer prices to the bond markets to mortgage rates and the housing economy. If you've been paying attention, then you know the market's not holding back on its thoughts about tariffs. It hates them. And to be honest, we're at one of those unique moments in time that could end up being one of the most political events in recent history. Right now, we're seeing pressure in both the stock market as well as the bond market, with stocks falling and mortgage rates bouncing all over the place. And here's the thing, it's not inflation or jobs driving it anymore. It's tariffs, it's politics, and it's causing big problems for both bonds and the housing market. So in today's video, we're going to talk about tariffs in detail. We're going to talk about why we have all of this uncertainty and volatility out there in the moment, what it's likely to mean for future mortgage rates, so that ultimately you can make the best decisions for yourself if you're looking to buy a home in 2025. Now, before we get started, I want to talk about tariffs in a little bit more detail. There's a lot of people out there that don't truly understand what's happening with tariffs, why we're even talking about tariffs, and why they're having the impact that they are. So first, let's start with a quick refresher. A tariff is a tax on imported goods, and the US has run consistent trade deficits with many countries for decades, meaning that we import more from them than we're actually exporting. And last week, as you probably know, the Trump administration imposed new tariffs with higher rates aimed at countries that have way larger trade surpluses than we have. Now, if you're wondering why, well, here's the thinking behind it. The first one being reshoring, with the idea that if we make foreign goods more expensive, then in that case, the US goods will become more attractive, which in turn, in theory, creates more jobs here in the United States. Now, the second thing is revenue. Whenever we impose these tariffs, in theory, it creates more revenue for our federal government. And the third thing mainly being debts and rates, which is if we weaken our economy enough, interest rates should move lower, which in turn gives the US an opportunity to refinance our own debt at lower interest rates. Now, there are some other things out there, but those are the three main points. But the question is, are these goals actually realistic? Well, reshoring sounds great, but in practice, it's honestly a tough sell. Most Americans aren't lining up to take lower wage manufacturing jobs. And on top of that, we have a skills gap with our workforce. At the moment, our young people are focused on entrepreneurship. They're focused on being social media influencers. Some are focused on being YouTubers. And maybe AI helps solve some of that in the long run, but here's the thing, we're not there yet. And on the revenue side, yes, tariffs do bring in money, but they also drive up prices and in turn can trigger retaliation, which is what we've already seen. And if other countries hit our exports, it can not only slow down US industries, but it will also hurt jobs. And when it comes to rates and debts, well, that theory isn't working out so far because we're actually seeing the opposite happen. The 10-year has actually risen to the highest level that we've seen in months, while at the same time, the stock market has been tanking. So what's the real impact here? Well, at the moment, our US economy is way more dependent on imports than it's ever been. In fact, imports made up 14% of our GDP in 2024. And that's because we've had a huge increase in globalization going all the way back from the 1970s through the late 2000s, which in turn makes us way more vulnerable when it comes to a trade war. So in my opinion, there's really two ways this whole thing can go. The first being smaller trade-reliant countries like Vietnam may offer something like zero tariffs just to keep access open to the US market. And that in turn allows our current administration to claim a win. Or it goes the opposite way and we continue to hold firm and this whole trade war drags on for months or even years with this idea that we're not going to give up on the reshoring, that we want to bring these jobs back to the US. Here's my question to you. Do you want to sit in a factory here in the United States and work all day, say 18 hours, and make $50 a day to make an iPhone? The easy answer is no. And that's why I think a lot of this is silly. But personally, I think the first scenario is way more likely. In fact, we've actually seen Trump blink a little bit, announcing a 90-day pause on tariffs for all countries except for China. Now, China's a different story, and I'll talk about it more at the end of the video. But right now, I want to talk about why mortgage rates are so volatile. Over the last couple of years, mortgage rates have primarily followed what's happening with inflation, what's happening with employment. When we get good news on the inflation front and inflation comes down, typically mortgage rates follow. And the opposite has been true when inflation has gone higher, employment has come in way stronger than expected, we've actually seen mortgage rates move up. But as we said earlier, the market at the moment is really reacting more to those political headlines along with the global trade fears, which is why we saw that sell-off in bonds, why we saw that sell-off in stocks. And as you know, that's not normal. In fact, our recent inflation data came in way better than expected, with core month over month coming in at 0.01% versus 0.03%. And that allowed core inflation to come in at 2.7% versus the 3% that was expected. Now, I don't need to tell you that's a huge beat. And typically when we see a deviation of that size, we would actually see the bond market rally. We would see mortgage rates improve. But this time, bonds barely moved. In fact, we saw the bond market move the other way. Mortgage rates actually went higher. So the question is why? Here's the thing. Markets are already pricing in future inflation risk from tariffs, which isn't currently being reflected in the CPI. That's why I spent the time to talk about tariffs, because at the moment, traders aren't confident that inflation is actually going to stay low, that it's going to continue to be, especially if this whole tariff war thing escalates. So before we talk about what's really going on with bonds, do me a favor and hit that thumbs up if you find any value in a video like this. This is a little bit different than what I typically talk about, but I'd love for you to let me know in the comments if you like this type of content. And do me a favor and subscribe to the channel if you want to stay updated on everything housing related. So mortgage bonds sold off as CPI improved, and at the same time we saw stocks fall, which is completely unusual. So let's take a minute here and talk about why. So the first is this idea of unwinding of carry trades. Hedge funds may be selling off treasuries in order to cover margin call. Now the next is foreign banks may be pulling back on actually buying more treasuries. And if we have more treasuries being issued in order to offset revenue drops, that not only increases supply, but also pushes yields even higher. Now, on top of that, it's important to note that foreign countries hold about 31% of our publicly held debt, with Japan having over $1 trillion in treasury, China holding around $760 billion, with the UK sitting just below that. So if foreign demand shrinks for US treasuries and these countries pull back on buying, or in some cases maybe they start to sell, then here's the catch. That'll likely push rates up even more. So what does this actually mean for mortgage rates? What does this mean for housing in the interim? Well, the biggest risk to real estate isn't the tariffs themselves, and that's because a large majority, over 90% of construction goods for residential housing actually come from here in the United States. But the real danger actually comes from these broader economic conditions, the unknowns, the volatility, because those unknowns, those volatility likely means rising interest rates. It also means less buyer demand, which in turn creates this overall uncertainty in the market. Now, the good news is we have seen this 90-day tariff pause cause some relief in the market, but the reality is it's probably temporary, and it's definitely not enough to calm those long-term concerns. So in the short term, I think you should expect volatility primarily in mortgage rates. And if mortgage rates continue to go up, those higher rates are going to mean less affordability. In turn, less affordability likely means lower buyer demand. And lower buyer demand likely means inventory is going to continue to grow. Inventory is up about 35% over last year, which to be honest is a good thing. We want to see properties continuing to come to the market. Now with that said, we've seen the market continue to appreciate in many areas. In many areas of the country, the housing market is still really hot. And that's because demand has exceeded supply. But here's the caveat. If mortgage rates continue to go up, that buyer demand is likely going to subside, and you're going to have inventory continuing to grow, which in some areas of the country means a more balanced market. But in other areas of the country, like Florida, like Texas, which currently holds over 30% of the nationwide inventory, if you get inventory continuing to grow in those markets and buyer demand's not coming to the table, then those markets are going to be even more of a seller's market, which in turn means more price reductions, means homes sitting on the market longer. I know a lot of you are out there watching going, well, what are the chances of mortgage rates moving back lower, back under 4% on the 10-year, so that we can see interest rates in the low sixes? Well, unfortunately, at the moment, I see that as a low probability until we get something for certain. At the moment, this market instability equals tighter credit. It equals higher bond yields, which in turn equals higher rates. So for the time being, it looks like continued volatility, which means if you're closing a home soon, or you're somebody out there shopping in the market at the moment and you get something under contract, my opinion is you should lock it, because it looks like just a little bad news makes interest rates go way higher, whereas great news like lower inflation did little to impact mortgage rates overall. So at the moment, it doesn't really look like the market cares about the things it's been following over the last couple of years is just primarily focused on the trade war and what President Trump has to say. Now, to go along with that, if you're weeks out from buying a home, say for example you're buying new construction and it's not going to close until the end of May or maybe June, then I think you can float your rate as long as you understand the risk that's associated with that. Understand that rates could go higher from here, that this might not be the top end rate. And the main reason for that is because the market sentiment has been flipped. Unfortunately, good news isn't good enough anymore. And that's because it's not about data anymore. It has everything to do with global uncertainty. So if you're in the market now, just make sure you're playing defense. Lock smart and don't gamble on volatility trying to get the absolute lowest rate in the market. The reality is the next 90 days are going to be a roller coaster. And if this continues down the path that a lot of people think we're headed on, that likely means a recession. And if you want to know how that's going to impact mortgage rates, do me a favor and check out this video here.